All right. Well, thank you everyone for attending this month's market update webinar for the month of June. Let's get started with disclosures. Silverstone Financial LLC is a registered investment advisor. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Please be sure to first consult with a qualified financial advisor and/or tax professional before implementing anything discussed within the presentation. And of course, past performance is not a guarantee of future results. You can read more disclosures on our website, and throughout the presentation, please feel free to submit any questions you have using the Q&A button at the bottom. Quick bio about us. Silverstone Financial, the firm, is a fee-only fiduciary independent wealth management firm. We provide comprehensive wealth management services, including financial planning, investment management, tax preparation, estate planning, and so on. You can learn more about us on our website. And my name is Jeremy Eppley. My co-panelist is Gordon Achtermann. We're both certified financial planning professionals. We both have our master's degrees in financial planning or an MBA. I specialize in inheritance optimization and gift and estate planning, while Gordon focuses on retirement planning and helping individuals invest in ways that are aligned with their values. We can start with my favorite graphic when in this presentation usually is the heat map, is how I look at the markets every day. For those that haven't seen it before, the larger the square, the larger the company. The greener the square, the more returns it had over the specific period. The redder, the more losses that it had. And the heat map is grouped into the 11 sectors or industries of technology or consumer defensive or healthcare. So this is how a lot of financial professionals look at the markets. It gives a lot of data very quickly to understand, oh, well, this red box right here is all of healthcare all moved together. So it probably wasn't specific to a specific company. There was something that happened that affected all the companies in that industry. So you can see some of the really big squares. So that's what we call mega cap companies, very large companies. They did quite well the past month. They recovered swiftly after the entire stock market being beaten up previously at the beginning of this year, after Trump had announced lots of tariffs and such. This month, the market has become a little bit more comfortable, I guess we can say, or optimistic about how much these tariffs are actually going to be implemented and how much impact they will have on the economy. We'll definitely discuss a little bit far later in the presentation our opinions about all that. We might be a little bit more cautious than the market as a whole, but it's interesting to see the markets recover swiftly this past month. As I mentioned, the largest companies, the top 50 largest companies, had the best returns of 7.5% in the past month. The S&P 500, so broadening that pool from the top 50 to the top 500, had a return of 6.25%. S&P GARP, which refers to growth at a reasonable price, that's our preferred way of investing. That's how many of our clients are invested. It's a little bit more of a conservative investment strategy than just the investing in the mega cap top 50 companies. That returned 5.3% in the past month. And GARP, growth at a reasonable price, that index is skewed to smaller cap companies in general. So it's a little bit more in line with what we see with the small caps here, having returned the worst out of this cohort of US companies of 5.2%. Global ex-US returned 4.8% for the month. The previous month and throughout the beginning of the year, non-US equities, non-US companies and stocks, that's what that refers to, have performed quite well as lots of investors fled the U.S. with Trump administration implementing a lot of um, um, isolationist policies. So we see a little bit of a reversion of that, where people are coming back into the U.S. a little bit faster than they're investing in foreign companies, but still 4.8% return in a month is a very strong month. Bonds are mostly flat, slightly down, down 0.6%. That has to do a lot with what I'm referring to here, which is called a risk on trade, where you go to bonds when you're fearful, you're trying to get risk off, versus there's a little bit less fear, or there's a little more confidence, a little more optimism in the markets. So we're back to a risk on trade, which means bonds would be sold off in favor of buying equities, which is why you see a slight downtick in bonds. Gold almost perfectly flat, not much happening, at least this past month. Oil up 4%. Don't put too much weight into month-to-month fluctuations of oil. Oil is very, very volatile and goes up and down often. And Bitcoin, another very, very volatile class, and has returned 11% after not doing too great for the past year. I'll just quickly show the year-to-date chart. So that last graphic was for just the past month, the month of May, versus this shows January through till today. And you see a much more flat returns, where the S&P 500 was up 1%. The top 50 companies were down 1%. GARP was down 3%. Small caps, which was hurt the most, which are most vulnerable to these tariffs, were down 8%. Ex-US, as I had mentioned, it was a lot of people fled the US equity markets in favor of other markets like the Eurozone, or companies in Asia, specifically Japan and such, India. And so even though it was pretty even this past month, we still see global equities having outperformed significantly compared to US equities, which is not what they have done in the past 20 or 30 years. US has outperformed historically, but we see a little bit of what we call mean reversion, reverting back to a more normal outcome for both of those scenarios. The US coming back a little bit to where one would expect, instead of outperforming, and same thing with ex-US companies. Bonds up 2% for the year. Gold for the year, even though not much happened the past month, is up 25% year to date. Usually gold is linked to fears about the economy, or fears about inflation. So there's still clearly some fears, even though it didn't continue going up this month. People held on to their gold, it seems. And that's very much a hedge against fear or recession or economies. So we'll have to see what gold does. Crude oil, again, pretty volatile, but being down 15% for the year. And Bitcoin, almost all of that return for the year has come in the past month, since the past month was about 11%, and we have 12% for year to date. This is another graphic that I like to show each month. This is it shows the cyclicality and the seasonality of the stock market. A lot of people don't actually think about how the stock market month to month has some trends that you can look at. And historically, September is the worst month in the stock market, and historically the best month in the stock market is December, and the best run up is October, November, December, January. On average, is all green, going up and up and up. You might have heard of the Santa Claus rally. Those kinds of seasonality or cyclicality events will affect these trends. So the outside circle shows historic average returns for the past 70, 80 years. The inside circle shows what we actually have experienced so far this year. So we're definitely bucking trends. It's not following averages, which averages are averages. They are not what you should necessarily expect for any specific month. But as soon as Trump was elected, there was a lot of volatility and turmoil. And now we're kind of mean reverting, or recovering a little bit Maybe the market's overreacted, maybe they're underreacting now. It's unsure, but it's interesting to see how we're definitely not following what would be a normal average trading year. And then this last graphic, and then we'll get into some news, is the S&P 500 daily chart. So this is what we call a candle chart in finance, where it shows every single day is what we call a candle. It's either green or red. If it's red, the market fell that day. If it's green, the market rose that day. And I kept the exact same graphics, the exact same annotations, drawings that I had last month. Mostly because there isn't that much new that I wanted to show, but I want to show now that we've zoomed out an extra month, we have an extra month of data where I was saying, well, there's this big dip and then this quick recovery. I don't remember saying that I thought it would go up or go down from then, but you can see that this recovery has continued and we're back to about where the beginning of the year had started at this almost 6,000 number for the S&P 500. So again, I don't have that much to say right here. It's still pretty volatile. These short candles usually mean that's pretty stable versus these very long candles. That's fear in the markets. It gets headlines. It makes clients and you worried about what's happening. We see a little bit of some smaller candles, but that doesn't mean that everything will calm down. Some more volatility might come our way. All right, well, that's all I have to say. I think we're going to get into some notable events. These past 2 months, or this past month has had a lot of finance news that we wanted to cover. We had about 20 news articles, and we whittled it down to 15, which is still a lot of news articles to cover. But all of these we felt had some interesting stories that we wanted to share. I think Gordon's going to start out with these economic outlook events.
Yeah, so the first and maybe one of, well, these are all interesting things to me, but so anyway, the first one, the House passed Trump's tax cut bill and sent it to the Senate. One of the immediate reactions in the markets was that long-term bonds trended up, 20 and 30-year bonds. There's kind of an odd yield curve where there's kind of a dip in the middle and then goes back up. It's kind of a weird S-shaped curve or something. And so that's based on worries about inflation in the long term. The Congressional Budget Office says it'll add $2.3 trillion to the national debt. The Committee for Responsible Spending says it's more like 3 trillion. You know, the thing to keep in mind here is this is a long process. A lot of senators have been saying, you know, it should be separate bills around the spending and the taxes. Senator Johnson today, Ron Johnson, he's one of the most senior senators on the Republican side, you know, vowed to vote against it. But you know, the Senate's unlikely to pass the same thing, and then there'll be a conference, and what ultimately gets enacted, we still don't know. So I feel like trading on this news is really getting ahead of itself. But you know, that's what markets do. They try to predict the future, and you know, well, it'll be interesting to see how that plays out. So the second one here, the trade court blocked Trump's tariffs, ruling that they exceed his legal authority. And you know, it'll be really interesting to see how this winds its way through the courts. The same court stopped some Biden initiatives around trade, and so you know, we'll see just how politicized things have gotten if they allow Trump's, invocation of an emergency to stand. It's a 1975 law that Congress granted the president uh, authorization to make decisions like that in cases of emergency. But, you know, how do you define that? I guess it depends. It's all emergencies are in the eye of the beholder. And so we'll be keeping an eye on how this winds its way through the court system. And then, Jeremy, you want to take a swing at these last three?
Sure. So since we have so many article news events that we want to cover, some of these we are going to fly through a little quicker than others. This next one, I just wanted to mention where Trump pushes Powell. So the Powell is Jerome Powell, head of the Federal Reserve, who dictates a lot of interest rates and other monetary effects that affects the economy, that affect how we spend money, whether or not we buy that car, we get that mortgage. So Trump has often said many times, trying to influence Powell and the rest of the committee at the Federal Reserve to lower interest rates. This was not surprising. As soon as there's any kind of weakness, he would push the Federal Reserve to cut rates. Cutting rates is good in the short term. It makes spending cheaper. It's stimulative to the economy. But if money is too cheap, which is what we saw in during the pandemic, inflation happens, and inflation can become lodged in the economy and very difficult to undo to prevent continuous inflation. And the fear, of course, is to get to hyperinflation or to get to what we call stagflation, where you have inflation but not growth. So it's common for I will say it is common for political parties to want lower rates so that they can boost their ratings. They have short-term bumps. What is not common is for any kind of presidents to try to influence the Federal Reserve. Of all of the nation's various agencies, the Federal Reserve is traditionally very clearly independent and is not supposed to be swayed by politics. And it definitely makes me fearful, Trump being the only president that I know of in the past century or so, to try to influence the Federal Reserve in such a blatant way. But I don't think he will have much power over the Fed. Hopefully they keep their independence and they do what is right for the economy long term, not necessarily what is right short term for any political party or any kind of special interests there. The other two events here that I want to discuss was Moody's downgrade of the United States credit rating. Prior to Moody, Standard & Poor's downgraded the United States credit rating in 2011. Fitch downgraded in 2023. All of these, Fitch, Standard & Poor's, Moody's, these are what are called credit rating agencies. They rate companies' ability to pay and also government's ability to pay back their debts. And as our deficit continues to grow and our debt continues to grow, it's not surprising that there are fears of, can the U.S. ever pay back its debts, or at least service its debts, which is the more common way, where it's you're never going to pay it down, but you at least can pay the interest on it. This isn't surprising. I wouldn't be surprised if we continue to see downgrades in our lifetimes, as at least there have been no indications of debt reduction, not even in terms of slowdown of growth of the debt. So we'll see how all this goes. We'll keep it tracked for all of you, and if we see other downgrades, we'll mention it. I'll also just mention that if ratings fall too much, then what will happen is the interest rates that are charged on U.S. government debts won't be dictated by agencies like the Federal Reserve. They'll start becoming dictated by the market and what the market deems its necessary risk premium to take on the debt of the United States government. And that starts becoming a problem if the Federal Reserve doesn't have the ability to essentially manipulate markets to do what is best for the economy. And markets start dictating what is best for themselves. It could start breaking some financial systems and causing financial crises. Of course, this is usually problems for decades rather than for any short, 1 or 2 or month or year trades. So these are slow unwinding train wrecks that potentially happen, but hopefully not for a very long time, and hopefully we reverse course and have fiscal discipline and don't pass tax bills that could cause this exacerbated problem. This last one here that I just want to mention, since it doesn't affect most of you, was that Japan loses its top creditor status to Germany for the first time in 34 years. Gordon and I had actually been talking about this article earlier today, and we have been discussing the different large creditor nations, whereas Japan, Germany, China. And originally, when I had read the article's headline, I had thought that it meant that China was now the US's largest loaner of money that held the most US debt. But that's not what this event was about. It's actually talking about all debts that different governments are lending each other. And Japan for 34 years was lending more money to more nations than anyone else. Just now, Germany has crossed that threshold, becoming now Germany being the largest creditor nation. China's up there as well. For the US specifically, it goes Japan and then China for the largest nations that own our debts and lend us money. With all that said, though, the majority of US debt is held by US companies and US investors. So it's not like we are beholden to a foreign government. And even if we were beholden to a foreign government, it's the whole problem of how are they going to force you to pay it back if you have a larger army than them? Like, it starts getting a little bit nebulous, which we don't need to get into. But with this change, I wouldn't be surprised to see further changes in the Japanese economy. We've seen some, I think I mentioned in previous webinars, of Japan raising interest rates, and it had caused what's called the carry trade to reverse, which we had discussed in a fall webinar, I believe. But Japan has had negative interest rates for a long period of time, which is crazy to say. And then now they're starting to raise interest rates for various reasons affecting their economy. And as they raise interest rates, it breaks a lot of the financial systems that have been in place for 20 or 30 years, where historically people would borrow money for very, very low rates in Japan and then invest in high returning places like the US. Now, if that starts changing and Japan is no longer lending us money for very, very cheap, it kind of changes some dynamics about the world economy and how our stock markets work and how our financial systems work. We're going to be watching this. We might make necessary changes to portfolios. This is what we call high-level finance, where it's not something that should affect everyday Americans. But for us finance nerds that enjoy getting into the weeds of how things work and various anticipated changes, we enjoy it. Anything you want to add to this slide, Gordon?
Well, it is surprising about Germany, but they have tremendous fiscal discipline, and interest rates are lower in the Eurozone than they are here, and that's part of the reason why the Eurozone stock market is up 20. Just the Eurozone alone, I believe, is up 26% this year. Really spectacular performance. And so, Germany's pretty well positioned and driving a lot of that. Very interesting. So I thought this slide was really interesting when I saw this graphic. And it's just kind of a reminder that, you know, this, so this red line is Republicans' view of what their expectations are for future inflation. And when the election came, it fell tremendously. And Democrats, the opposite happened. And this happens every time when the party that controls the White House changes. The people who are out of power become more pessimistic, and the people who are in power become more optimistic. Um, Interestingly, independents tended to agree more closely with Democrats in this case. But um, you know, it's just a reminder to be careful to separate our political views from our economic thinking. And yeah, University of Michigan does a lot of um, high quality surveys, and this is one of them. So I thought that was really interesting.
Great.
So yeah, a couple of scandals here. So UnitedHealth apparently, well, according to a story broken by The Guardian, which is a UK newspaper, they paid nursing homes to reduce hospital transfers, trying to um, lower their costs because, you know, so you're a health insurance company covering major medical, you're paying people's bills or insuring them when they're in the hospital, but not when they're in the nursing home. So if you're the health insurance company, you want to keep people in the nursing home longer rather than sending them to the hospital. Um, there's kind of been a number of scandals with United Health this year. They had a big cyber attack. There have been other criminal and civil investigations, and their stock opened at 508 at the beginning of the year, and now it's at 300 today. So that's a 41% drop. Um, as is often the case with things like this, one scandal companies recover from, but when it starts looking like a pattern, that can have a long-term uh, disastrous effect. And United Healthcare is um, one of the biggest companies in the country. That's kind of the biggest gorilla in the healthcare field. So worth keeping an eye on that. Capital One simultaneously somewhat um, is going to have to pay $425 million to settle a savings account lawsuit. This was a case where they had these certain kind of savings accounts with a high teaser rate, and they said, well, we'll keep you in a high earning account. And instead, they dropped the interest that they were paying in these supposedly high yielding accounts down to 0.3%. And then they simultaneously were signing up new customers at 3.6% with an account with an almost identical name. And so they're going to have to reimburse people who they paid lower rates to. Um, yeah, so that's the story on those two scandals. Um, and Jeremy, you want to talk about Coinbase and these next
Yeah.
ones?
Well, I'll also mention I personally use Capital One. I in general have pretty high view, especially if they're savings and checking accounts. And I don't believe I was one of the ones affected. Like I'm sure there's more research to be done. This is an outsider's view, but like if I was in the 360 savings, I still use it. And I don't think they reduced my interest rates. I follow that pretty closely. It does really seem like it was the bait and switch of various deals that were then not followed through on, whereas like um, so hopefully this prevents them from doing that again, and we'll have to see if there's a pattern of issues like we see with United Healthcare, and uh, hopefully not. So Coinbase, this is still trying to be figured out, from my understanding, where there was a up to $400 million breach for account data and such. It seems that a foreign cyber criminal gang group paid Coinbase employees to give them various data or access to various systems, which let them get data like names and addresses and emails, but they didn't get credentials like passwords. They weren't able to log into accounts, but what the attackers, the hackers ended up doing was doing social engineering attacks, which convinced people to send funds and such, and ended up, they ransomed Coinbase for $20 million. Coinbase has a policy of not paying ransom, so they did not. What they did do was fire the employees and are trying to reimburse various clients for money that was stolen from them. Coinbase, for those that don't know, is the largest US cryptocurrency exchange. In general, it's usually seen as the safest, even with the cyber attack. It's regulated, unlike the big scandals before with Sam Bankman-Fried being in the Cayman Islands, the Bahamas. I forget which exact place he was at, where it wasn't regulated and they were able to commit fraud. Versus Coinbase is a public U.S. company regulated by the Securities and Exchange Commission, and a lot of the major U.S. exchange traded funds that hold Bitcoin, such as BlackRock's IBIT or ARK's Coinbase ETF or Invesco's Coinbase ETF. All of these are custodied at Coinbase. So Coinbase is the backend that runs that. The big exclusion from that is Fidelity. Fidelity has their own cryptocurrency custody company, a subsidiary, and they do their own. And for us personally, a few of our clients, a few of our model portfolios that we manage for them have a small portion, 2.5% or less allocation to Bitcoin, to cryptocurrency. And we specifically use Fidelity. I've long thought that Fidelity has a better track record than Coinbase for not only their security, but also just their compliance to regulatory agents, essentially, where Coinbase, even though they are regulated, I've always found them to be a little bit flippant to regulators. They don't follow as much of the rules. So with that said, Coinbase in general is relatively safe, most people say, but an interesting cyber attack, and we'll see if more of these will continue. It's not surprising when you have billions of dollars, there's some hacker that wants it. So it's a constant struggle between the good guys, the bad guys, very Wild West. So the most interesting story for me personally was this next story that I'm very excited about, which the SEC is going to be allowing mutual fund managers to offer an ETF share class very soon. So that doesn't sound like a big news, but for actual impact to investors, this is big news. Where, for those of you, I guess, let me do a little bit of education on the different types of mutual funds and exchange traded funds. So an exchange traded fund is like a mutual fund, but it trades intraday, which means you can go to the stock exchange and sell it immediately. Instead of a mutual fund, you have to wait until the end of the day. And you redeem it once with the company that issued it, rather than selling it to some stranger on a stock exchange. And there are a lot of benefits to exchange traded funds. The most common one that people discuss is that there are tax advantages to exchange traded funds, but there are also other advantages, not only the liquidity where you can sell it intraday, but a lot of these funds are what we call optionable, or also they are lendable. So that means you can lend out your exchange traded fund and be paid for someone else using it to short it. Or you can, optionable means you can buy protections. You can buy puts on it, or you can get higher yield by selling calls as protective puts or covered call strategies. All of which you can't really do with mutual funds because you don't have the fund to make these deals with. It is at the mutual fund company. So now that the SEC is starting to allow what's called an additional share class. So a lot of mutual funds historically had what's called A share, B share, C share, and it just depended on how the fees worked. Eventually, they introduced what's called institutional shares. Now we're going to be able to have a mutual fund. So, say a Fidelity mutual fund that has A shares, B shares, C shares, institutional shares, and ETF share classes. And it's all the same mutual fund, the same pool of money, but it allows different investors to get access to these funds in different ways and pay different levels of fees depending on their needs or how they qualify. Overall, it's great news in my opinion. It will provide a lot more mutual funds. It's estimated about 3,000 mutual funds will be able to become ETFs, which will make us as money managers. At least I heavily prefer exchange traded funds over mutual funds for a variety of reasons. Having access to 3,000 more to increase your sample size, increase your options, filter to find the best of the best is awesome. Historically, I forget if they had a patent or they just had some sort of level that some sort of connection that allowed them to do so. But Vanguard was the only company for 10 years. I think they introduced in early 2010s where they were able to have an ETF share class. And now everyone will, assuming that they file and are approved by the SEC, will be able to have these ETF share classes, which will make a lot more investors, much more tax efficient, much more liquid, lots of benefits. One warning for those that are excited about this, especially in the beginning, where a lot of newspapers are calling the tsunami of ETFs that are coming. When you have 3,000 new ETFs and everyone's trying to trade them, and so they'll be what we call thinly traded, which means they won't actually be that liquid because there aren't that many sellers or that many buyers for every seller. So what will happen is spreads will increase, and that just means the person on the other side of the trade will want some sort of compensation for the liquidity that they're offering you. That's called a liquidity premium. So it might actually be very expensive. It might end up causing problems, and so maybe I recommend waiting, seeing how it goes, see which exchange traded funds that are newly issued are actually liquid. Don't necessarily jump in day one, but we'll be watching it closely and might be implementing some of these new ETFs. Just a quick one, not much to say about this, but the fifth article that we want to discuss, event that we want to discuss, was the U.S. Treasury confirms that it will stop producing the U.S. penny next year. This has been long discussed. It became a priority for the Trump administration. They consider it wasteful to mint a penny that's worth 1 penny but costs, I forget how much, 3 cents, 4 cents to make. Honestly, makes sense. I personally haven't used hard cash or coins for the past decade. So everything it being digital, I'm not going to miss the penny other than it being, cool to have. But it will be interesting to see how retailers react, where will we start seeing a lot more, 99 cents at the end of prices, or will it still be 99 cents? And just because of how we're used to that, will taxes, will people have to round up if they're paying cash, they don't have the pennies? It'll be interesting to see. Anything you want to add, Gordon?
Yeah, it's ironic that nickels, the ratio of value to the cost to mint is even higher. But
Yeah.
I don't know that we'll need any more nickels because of the loss of the penny. We'll see.
Well, I feel like I was surprised, honestly, when they were talking about it. It's like, why not get rid of the penny and the nickel, and the dime, just have the quarter? I don't know. Maybe that's way too aggressive. We'll see. All right.
So we've got some mergers and acquisition news here. OpenAI, is I believe the biggest player in the they own ChatGPT, right? So
Yeah.
they're the biggest kind of player right now. And they bought this tiny little startup called IO, which they're paying $6.4 billion in stock. And I think that that last part is kind of indicative of something. So when if you're a business owner and you feel like your stock is something you want to keep as much as possible, you're going to try and buy. If you're going to buy a company, you want to buy it with cash because you think it's going to go up. But if you're a business owner and you feel like, hey, my stock is really like at a high value, let's buy an asset like another company and pay stock for it. I'm old enough to remember when AOL bought Time Warner. I believe that was right around when the dot-com bubble burst on year 2000, 1999 or something. And, the owner of AOL, Steve Case, founder, CEO, and majority shareholder, it turned out to be a perfect timing because that's right when AOL stock was at its peak. And he got this legacy media company that, has been carved up into different pieces and different owners and things. But anyway, um, that was the best use of his stock because it seems like he knew that it had peaked. So it'll be interesting to see if OpenAI has reached the peak. The second one there, Regeneron, is to buy the bankrupt genetic testing company 23andMe. So they're paying $256 million, considerably less than the $6.4 billion on the one before. And they are saying they're going to that they're vowing ethical use of DNA data. There was some criticism of 23andMe's selling of client data, although it was probably, I believe it was anonymous, it wasn't like linked to specific people. But, and also there was a 2023, sorry about that. There was a 2023 data breach with 23andMe that really hurt the company, and its viability became questionable at that point. So Regeneron has a pretty good track record, and that's something we'll be keeping an eye on. It's a scientifically interesting space to me. As we know, genome medicine is extremely promising. Using genetically targeted medicines for cancer seems to be getting us closer and closer to the promised land of defeating more types of cancer. So anyway, and Jeremy, you're going to talk about Capital One again.
Yeah, a lot of news for Capital One. So last month I just mentioned that they were going, Capital One was set. They had all the approvals to close on acquiring Discover, making them the largest credit card issuer in the country. Actually, I would say in the world. The bigger news to me was the potential for with the combining of those two and Capital One getting access to the Discover payment network, which actually powers the Discover card, it might be able to compete with Visa and MasterCard, which have a duopoly, which have a massive market share and causes merchant fees to be high on credit cards, which ultimately gets passed on to the consumer. So it's potential, like the fear is there's gonna be less competition in the credit card space, but I am hopeful that at least there'll be additional competition in the credit card processing space, and hopefully that additional competition could reduce fees for consumers in the end. So they ended up, Capital One did acquire, I think it was the 18th or so of last month, as both a Discover and Capital One user. In general, I like their products and I like their the banks and the services. I'll be following it very closely because I'm interested to see when my Discover login will no longer be allowed, and when my Discover card will show up under my Capital One account. We shall see. I'm sure maybe I'll throw that in as a bonus. Hey, I now have one login for those that are waiting to get their Discover card for the first time that doesn't want to have to go through a migration process in the future. But interesting to see. Another big bank who, at least not recently, but historically has had lots of scandals, just like Capital One's recent one, is Wells Fargo. So for those of you that remember Wells Fargo, well, many times, I guess it depends on which one you're trying to remember, but has had lots and lots of scandals. They had, I think the most famous one was they opened fake accounts under client names, and that was because of their work culture where various people were compensated based on the number that you could open, and they had access to systems to open it for like these fictitious ones that then ended up causing problems and fees and data stuff. And so in general, just across the board, Wells Fargo, not a big fan of the bank. Also, for those of you that use Wells Fargo, their checking account has lots of fees, and their savings account pays almost 0.01% in interest. Yeah, not, in my opinion, the best company to be a client of, be a customer of. Anyway, the Federal Reserve, though, has deemed them to have fixed enough of their problems where they are being released of what's called their asset cap. So the Federal Reserve, other than determining interest rates and various monetary decisions, they are the bank regulator. So they regulate banks. And in a punitive way to punish Wells Fargo for their misbehavior, their culture problems, everything like that, they had implemented what's called an asset cap, where they weren't allowed to aggressively grow, market, acquire other banks to try to make themselves larger until they fix their problems. And so they had a $1.95 trillion, so let's say $2 trillion market cap, or asset cap rather, that they could not pass. And their CEO, Charlie Scharf, he joined in 2019, cleaned up some of their misdeeds. Just because their misdeeds are allegedly cleaned up doesn't necessarily mean that it's a good company for consumers, from at least my opinion. But they now have the right to pursue growth, where they can market more aggressively, acquire companies more aggressively, just do things more aggressively than they were originally allowed to. So we'll see if we see another scandal pop up, that the asset cap might come back, but we shall see. We shall see. All right, the 15th event, article news that we wanted to discuss this past month is a light one. It's on the edge of what I would consider finance news, but there's a big number attached to it, so I wanted to add it in there. So Taylor Swift, for a long time, for those Swifties out there that like her music, has known that she kind of had a breakup with her original music label. It was from, I believe his name was Scooter Braun, who owned that label. I had the first 6 albums of hers under that label, and they didn't have, she wanted to buy back her own music so that she could own it, have the rights to determine who gets to use it, in movies or in other media. And instead of even hearing her out, they sold it to various other companies, and it was passed around Scooter Braun's Ithaca Holdings Company, and then eventually to was here Shamrock Capital, which is a private equity firm. And it was announced last week, I believe, that Taylor Swift has officially bought her masters, which are those 6 original albums. She now owns all her work. She allegedly, it's not public, but allegedly paid close to $360 million for the albums. Somewhat ironic that she made them and she has to pay 360 million to get it back. But it's understanding about how the music labels work and the value they provide, if they provide value, and all of the various legal issues that come with the music industry. But happy news for Taylor, and an interesting one to end the webinar on. Any last comments, Gordon?
Well, we're coming into summer, and traditionally, summer is not as volatile or not as productive, but I think that's more and more of a myth. And so I'm expecting more interesting news every month for the foreseeable future.
All right. Well, I didn't see any Q&As come through. Hopefully that means that we were thorough during our presentation. But if any attendees or those of you that are watching afterwards on YouTube have any questions, feel free to reach out to us at team@silverstone.financial or on our website. You can contact us there. Happy to answer individual questions that aren't appropriate for a public webinar such as this. But yeah, if not, I suppose we'll see everyone again next month. The first Wednesday of each month at 6:30. You can sign up to watch the webinar live on our website. If you go to silverstonefiduciary.com or yourbestpathfp.com. If you hover over the blog section in the top right, you can then select underneath it the webinar sign up, and you can join us live and ask any questions that you have live. All right. Well, have a wonderful evening, everyone, and see you next month. See ya.